Good afternoon, ladies and gentlemen. Thank you very much for joining us this afternoon, where we have the pleasure of hosting one of our first investment series events of the year as KEPFIC. My name is Ngatia Kirungie. I am the head of the Secretariat and also the CEO of Spearhead Africa. We have the honor today of hosting Mr. Jean-Pierre Lacombe, who is the Director, Global Macroeconomics, Market Sector and Portfolio Research at the IFC. Jean-Pierre, allow me to read a little bit about your background. Jean-Pierre is the Director, as I mentioned, at the IFC. Based in Washington, D.C., and he provides to IFC's management, operational departments, and external clients with applied macroeconomics research, sector and country risk evaluations, and strategic asset allocation recommendations on emerging markets and global industries. His team also conducts empirical and fundamental economic research to gain insight on long-term trends affecting investments. And in addition, his team works with all operational departments to coordinate IFC's climate response at the country level, involving the domestic private sector. While still at IFC, he has worked in various capacities, including in the corporate portfolio management department and the central equity department, as well as the corporate strategy department. And prior to IFC, Jean-Pierre spent 15 years in the private sector with Johnson & Johnson, Lehman Brothers, and Barclays Capital across the globe. During his investment banking career, he headed institutional and proprietary trading in FX, fixed income, equities, and derivatives for Latin America and Asia emerging markets. And he has a degree in mechanical engineering and operations research from Cornell University and finance from MIT. JP, I'm really happy that we have been able to set up this conversation. You came to Nairobi not too long ago, where you paid us a visit at KEPFIC, and we had a really interesting conversation about the macroeconomic situation, but more importantly, or at least more targeted, about how we should be thinking about investing given all the global challenges that we are facing. Maybe just as a little bit of a background before I hand over to you. In Kenya specifically, we have seen how linked our local markets, not just even in Kenya, but in EM in general, is to how sensitive we are to global happenings. Our investment decision process has really shifted. In the early days, we were mainly just focused on company fundamentals locally here in our domestic market, but that has expanded to now our local domestic environment or local domestic situation. But now on top of that, there is the global macro environment, which seems to be shaping a lot of investor flows. So as local investors, we've had to build our understanding of the potential effects of these global macroeconomic events, like the tightening of rates in developed markets, both in the US and other developed markets, the war in Ukraine and the effect that has had on inflation, and all of which have had major repercussions on our local investment decision making. We also our market is, at least our equities market, is heavily driven by foreign investors. So getting a sense of how they're thinking about emerging markets or frontier markets would be very helpful. We know that they have been the active traders. Foreign investors have been the active traders in our market, but they have been net sellers over the last, I would say, 3 years. The last year, I think they had total outflows of just under $200 million, depending on what exchange rate you are using. And that's on the equity side. At the same time, bonds have not been the safe haven that we would have hoped. At least these are local bonds with concerns also around inflation on our side, the debt sustainability, and the market's expectation of higher rates. So, to summarize, so we have local equities don't seem great. We have local bonds that have been selling off, leaving us really to think about 2 or 3 different areas of diversification. The first being alternative assets, which is really KEPFIC's mandate, specifically around private equity, infrastructure, and the likes, hard assets. And everyone you see on this call is either a pension scheme trustee or is an investment professional that is aligned with our mandate. So we have the fund managers, we also have the administrators, as well as the investment advisors. So if we're not looking at local equities and we're not looking at local bonds, and we're saying there are alternatives that KEPFIC is already helping our members and the local pension scheme community look at, it leaves us with offshore investments. And offshore investments are allowed under our regulations. And what we have found primarily is these offshore investments tend to take the form of mutual funds or exchange traded funds, given their liquidity. But we also know that these offshore funds or these offshore opportunities have also gone through their fair share of pain. And that leaves us now wondering, where do we put our money? Is this the time to sit on cash? What are you seeing from your position looking at global markets, and any kind of insight that you could provide to the local investment professionals would be very valuable. And so with that, and without any further ado, Jean-Pierre, I would like to welcome you to this current investment webinar. And I'm not, we don't really have a structure to this, whether you have a presentation or not, but we just want to hand over to you to take us through some of your thoughts, and thereafter we can have a question and answer, which I will moderate. Over to you, Jean-Pierre. Thank you.
Thank you very much, Ngatia. This is very, very kind of you to invite me today to share with you. I have a presentation, and the gist of the presentation is for you to listen. You're going to have access to the presentation after our discussion. So do not try to basically look at every detail, but listen to the flow of basically the arguments and some of the shapes of the curves. So let me share my screen. I have to warn you, I also love to use some cartoons, because I believe cartoons are the best way to pass a message in a funny way that would take you otherwise many words to pass. So if you can see on your screen, you have a big bear that is swallowing the little jet of the Fed. And the captain on the plane says, flight attendants, please prepare for landing. So as of now, everybody and all the comments that you have seen in the press, at least 2 weeks ago, were preparing for basically a no landing or very soft landing. And I think the data that we have seen over the past 2 weeks have reset into a new reality, the market. And now people understand that you have a much more hawkish Fed in front of them than otherwise. So this morning, what I want to walk through is what are some of the drivers of the market, basically a performance, and towards the end, what do we believe that the outlook has for us? So, of course, one has to note that Wall Street didn't have the outlook very well, particularly at the end of last year, beginning of this year. because they didn't believe that the Fed was going to be so hawkish, and they believed that inflation was going down. They had an expectation that inflation would go down much faster than it is. And what we're finding out is that the current bout of inflation is much more sticky. If you have seen the inflation data released this morning out of France, 7.5%, quite much higher than expected. Also in Spain, 6.1%, again, much higher than expected. So the investment bankers that always take little happy pills in the morning, I think we're out of the reality with the stickiness of the inflation that was going on. So in order to explain this change of shift, we first need to see, well, what were investors looking for towards the end of last year and at the beginning of this year. So we can say that investors started the year with a very optimistic bravado. So they bought anything that was not nailed down to the floor, particularly the asset classes that underperformed last year. And you had three narratives that gave credence to this risk-taking episode. One is basically China. And in China, everybody was thinking that the reopening of China, so the lowering of COVID lockdowns in China was going to unleash a massive consumption boom in China that was going to refloat the boats from around the world. And even the IMF was much more optimistic in China's growth for 2023, as per the chief economist intervention in Davos early this year. The second one was moderating inflation prints. And the perception that the Fed, the tail that wags the global economy nowadays, was going to be much less hawkish going forward, and that the Fed pivot, meaning the end of rate increases and actually rate decreases, was much closer than people were thinking. And the last one is a growing consensus that the recession, if you remember, a lot of people were talking about the recession, that consensus started to wane, and a lot of people thought that it was going to be either mild or we were not going to have a recession at all. So this is interesting because we still do not have the conditions for a very pronounced equity market bottom. If you basically watch basically recessions and equity market bottoms, the market tends to flatten out only after the Fed has stopped tightening and is actually easing, and we're not there yet. So from the left-hand side of the chart, you see Fed fund futures, an initial period towards the end of 2022. Let me put my pointer here, towards the end of 2022, towards the beginning of 2023, where interest rates were moving lower. But look at what has happened over the past 2 weeks. Interest rates are again moving higher. And this is at the same time of where you have the balance sheets of central banks that are mostly going down, which means that not only do you have a tightening of liquidity because central banks are tightening rates, but also you have a tightening of liquidity because the central bank balance sheet is going down. Two exceptions to this is the Bank of Japan and the Bank of China. So a lot of this basically a lot of this tightening of balance sheets, particularly from the ECB and the US, has been counteracted by the increase in the balance sheets for both China and in particularly the Bank of Japan. Now, if you basically listen to some of the Fed's pronouncement after they have their meetings, it is very clear that most of the Fed governors basically want to see the economy decelerate. So as the Fed basically sings this little song our economy just won't grow, let it slow, let it slow, let it slow. So this is what the Fed wants to see, and I believe this is what the market did not understand very well, the ability of the Fed to continue raising rates and maintain them there for much, much longer. If one sees the US economy that everybody thought that we're going to be into a new cycle, let's look at some of the drivers of the US economy and let's try to make a little bit of sense out of the numbers. On the left-hand side, again, real average weekly wages have been contracting for a while. This tells you that inflationary pushes of inflation are not compensated enough by rising wages. Therefore, this affects the ability of the consumer to consume. And we see this not only in the US, but we see this in many advanced economies, in many developing economies, that inflation is going well beyond the capacity of wages to adjust, which leads to less consumption power by consumers. The second one in the States that is very interesting is basically housing. And we were warning that with interest rates going higher, housing was going to be one of the first ones that were going to be hit. And indeed, it was one of the first ones. So during the pandemic, everybody wanted to relocate outside the cities. The red line, the price increases. Everybody, at least in the States, was buying property in the country or at the beach. And then now with interest rates increases, you see prices going down. Look at the blue line, new basically home sales have also had a steady decline with some volatilities, and the green line, housing starts are basically plunging to a pace of 20%. So you cannot say that the US economy is also vibrant. If we take a look at two additional indicators, real non-defense capital good orders, these are the goods that are basically pro-cyclical goods. These are the big ticket items. And in both of them, you see new orders contracting and ISM manufacturing also basically contracting. So this does not give you the sense that the US economy is about to take off. And the last one that everybody is talking about is the unemployment picture. And in the unemployment, I basically pick three series to shed some light into it. The job openings level is still at an elevated pace. I think is starting to turn down. You are seeing, if you read the Fed Bench book, full-time employment being replaced by part-time employment in the States. And this is the new trend that we have been seeing. But we still have not seen unemployment reach to the levels of 4.5%, 5%, which is a must for the Fed to basically think about easing monetary policy. So we have a US economy that if you look at the high frequency data, you have some conflicting indicators, particularly inflation, services inflation is basically much higher than expected, and you have other cyclical parts of the economy that are decelerating. Now let's look at the markets. We warn already our management and our clients that we're going to have a very tumultuous 2022. And I believe that we are also going to have a very tumultuous 2023 in terms of market performance. Last year, around basically the beginning of the year, probably March last year, we warned that we believe that there was going to be a recession in the States starting in late 2022 or mid 2023, depending on basically the aggressiveness of the Fed. We believe that because of the interest rate differential and also the growth differential benefiting the US dollar was going to behave very well, which was going to be a headwind for a high beta assets or risk assets. And what we saw is exactly that. The green line, the dollar was performing extremely well, probably until October last year, and all other asset classes, if you see, basically tended to drift lower. It's only towards the end of last year that you had the story that I basically told you, the China reopening, no basically a recession in the States, that Again, and some inflationary prints that were a little bit more moderate, still very high, but more moderate, the dollar started basically selling off. And what happens? Basically, high beta assets rallied. Now, you have seen again what has happening as of late is the dollar rallying again because the Fed is not basically done, and risk assets again selling off. But what we said at the beginning of the year was the performance of risk assets so far was not basically going to be stellar for this year. And we effectively saw losses across broad asset classes. The S&P, the NASDAQ, the dollar index powered ahead, emerging market effects lost, equity also double-digit losses, the bond hard currency index in emerging market also lost, and of course the 10-year futures also lost because rates widen. And of course, this is because on the right-hand side, you have seen a dollar that has been surging. And why has it been surging? On the left-hand side, you see the interest rate differential between either the 5 or the 10-year on the favor of the US dollar. So if you have a combination of positive interest rate differentials and an economy that is doing relatively better, plus you have geopolitical events and a softer global economy, you're still going to get bouts of dollar strengths out there. The other one is if you look at the New York basically a Fed recession probability that stands basically at around 57%. And look at basically the previous recessions in gray. Nowhere have we been at such high levels of implied probability without a recession developing in the States. So we were one of the first ones early last year to call that there was going to be a recession in the States, and it was probably not going to be as mild as people were believing, and we still are on this camp as of today. So what does that mean in terms of riskier asset classes? If you are an investor and you're looking at basically equity, you have a dividend yield that is sub basically 2%, and you have both basically the very short end of the treasury curve that is trading at 5%, and the intermediate basically maturity ladder of the US Treasury curve that is trading with a 4% handle. So one thing we can say, it is easier for a fixed income investment today to return a positive return over the next 12 months than it is an equity investment today to return a significantly positive investment over the next 12 months. Particularly that equities, as we're going to see, are still not cheap and are somewhat expensive. Now, the second one is so far this year, profits have contracted by 3%. Well, last year, Q4, profits contracted by 3%. And you have incoming reduced earnings per share estimates for 2023. Now, if you look at it from a fundamental point of view, the cyclically adjusted PEs for the stock market is slightly above the historical average. It's still not cheap. And the PEG ratio is basically at 1.8 times. That only happened basically one level over the past 20 years, which is basically before we had the market correction in 2020. The third one that I want to keep your minds very much attuned to is the dollar renewed strength. Over the past 2 weeks, you have had the dollar that has renewed as a headwind for basically markets and define the risk on basically a trade. And again, as you know, a stronger dollar is negative for commodities and also emerging markets. And talking about commodities, oil is again trading lower because of anticipating demand destruction that you're going to have. Copper is also faltering near 4% after a very strong start of the year. Why is that important? Copper is like the canary of the coal mine in terms of the early manufacturing cycle, because it's a commodity that is pretty much adopted early whenever you have a cyclical a turnaround in the economy. So you really have to watch at the performance of copper to give you some hints as to what is going to happen. So if I look at basically the performance of asset classes, broad asset classes versus last year. So in light gray is the performance of asset classes like last year. So aside from basically commodities, pretty much everything else sold off last year. What sold off the more were the sovereign bonds and also emerging market equity, emerging market bonds, some of basically the equities around the world. Now, it is interesting to see that the assets in green and basically here that are in positive territory are the ones, some of the ones that lagged also a lot last year. So this is again the theme that I shared with you at the beginning of the presentation, that the laggers of last year, the market was basically buying them this year. But look at the distance between the bars to these little blue dots. The little blue dots are the high that each asset class reached this year. They are far away from basically the highs. They are much closer to the lows, meaning very close to an underperformance this year than to the highs. So that means that the risk aversion is really alive and well in markets. And why is this on the right-hand side? Is because, again, after a period of declining rates, rates have started to go again higher. Of very importance note is what is going on in Europe. Look at in Europe, although in the US rates are below the highs that they reached towards late last year, in Europe you have rates that are higher than the high that they reached last year. So this means for Europe that the ECB, given the inflationary prints, is going to be much more hawkish and is going to tighten, therefore weakening the European economy. Now, if I look at basically performance of commodity prices since early 2000, performance of asset classes since 2019, what could we see? We could see a clear decoupling about 2021 between commodities that went on a flare-up, the black line, and basically emerging markets and Euro stocks that went down. This is, of course, courtesy of the Ukraine war and also some underperformance of emerging markets, given basically a much stronger dollar and inflationary episodes in emerging markets. So far, we basically saw this rally at the beginning of this year, but look at what is going on again. The rally is petering out and valuations are basically contracting. Now, if one looks at cyclically adjusted P ratios on the right-hand side, where are we according to basically the long-term trends? We are exactly at the average. So both for developed, the S&P, and for emerging markets, we're at average levels. That doesn't mean that they're cheap, and we believe that there's going to be more downside in the pipeline. Now, what is basically driving emerging markets? Emerging markets is basically earnings expectations. And what you have seen early this year on the left-hand side is basically a divergence between the performance of emerging markets equities, the dotted blue line, and basically underlying earnings. So underlying earnings are not markedly turning higher, but equity performance has turned higher basically on the hopes that I mentioned earlier this year. So if we look at a little bit more into detail, what has that meant for FX performance and equity performance in emerging markets? So at the top of the list, you have countries with significant macro imbalances that have sold off. Egypt, because you have investor aversions to an overvalued currency. Argentina is the perennial, basically, problem child in the classroom. South Africa, you have some political turbulence, blackout, water shortages. Pakistan renegotiating an IMF program, some political noise, and basically some of the list it goes on. What is interesting is for you to see the countries that have performed better at the bottom. And some of these are in Latin America and Asia for the most part. It is exactly the same kind of a mix that you could see in terms of equity performance. So if you compare to the beginning of the year where the markets were at the highs, both in FX, look at the blue lozenges, and equities, markets have sold off definitely quite considerably since the beginning of the year. Now, I think to one of the comments that you were alluding to is how have portfolios fared? And I wanted to give you 4 examples of countries so far this year. So at the top, you took the performance of the stock indices for Brazil, China, India, and the US. And I wanted to look at the percent of members with at least a 10% correction of the 52-week highs. So pretty much the whole market in Brazil corrected at least 10%. And if we go down the list, 65% of the market had a correction of 25% or more, right? So the average decline in Brazil was around 37%, in China 21%, in India 13%, and in the US 19%. What also jumps at you is this overperformance on a relative basis of India versus basically both developed markets and emerging markets. And I believe that aside from the Adani scandal that brought very expensive valuations a little bit more into the sphere of the human race, India has been definitely, India has been definitely outperforming other markets. And why is that? You basically have more or less a political environment that is relatively quiet. You had decent performance. They were uncorrelated to some of the geopolitical risk that were happening elsewhere, and still you had companies that were producing substantial returns. So a lot of investors flocked to India, with the consequence that we all know, valuations were basically exorbitant. So it depends who you're looking at in terms of performance in emerging markets. And you can see that the performance both for developed markets and emerging markets is vastly different according to the country basically drivers. The other theme, if we look at the big picture, is the themes that investors were having. So when we entered the Ukraine-Russia, in here you have an underperformance of basically industrials and an overperformance of defensive. The line basically drops. At the end of last year, beginning of this year, we have the exact opposite. The people believe that the cycle is alive, that the economies are going to do much better, and defensive are underperformance. What is going to happen in the future is going to be very telling. Are we in another period where defensive assets are going to fare much better compared to industrial assets? That's one question for us to ponder. So the present, the economy slowed down in 2024. And the best, one of the best indicators is for you to look at basically PMI, so Purchaser Manager Index, that give you a sense of the vibrancy according to different sectors. Several things to point out. If you look at the dotted lines, which are developed markets, both the red line, which is manufacturing, and the blue line that is services, is in contraction. So developed markets are not doing well. Emerging markets, the manufacturing line is not doing that well. It's basically pretty much at at 50%, so no contraction, no expansion. You have some basically a expansion in services, particularly a lot of countries post-COVID where the tourism industry has exploded and you see tourists back in their economies. And that basically benefits also the services industry. Now, if you look at the bigger picture in terms of colors, and I'm a very visually oriented person. So if one looks from April 2021 to January 2023, just look at the colors. The top of the scale is developed markets. The bottom of the scale is emerging markets. Green is good, means that PMIs are expanding. Red and pink and yellow is not good because it means that PMIs are declining. So what you saw early last year, well, early in 2021, basically when coming out of COVID, is that you had a globalized pickup. Most of the countries were in green. Entering into 2022, the impetus faded, and first you started noticing some basically issues in emerging markets, and emerging markets industrial production basically slowed down well in advance of the developed economies. And then you have a globalized slowdown with both emerging markets and developed markets that are seeing PMIs or industrial production tick down. If one looks at it in terms of regions, you can see that pretty much all of the regions are not performing very well and are trending down. Africa, Latin America, Eastern Europe. And even the big economies, China, the US, the Eurozone, are all basically trending down. So you cannot infer from this that we are in the midst of a turnaround, a cyclical turnaround in the global economy. In fact, the global economy is slowing down as we speak. You also mentioned at the beginning that you wanted to know where people were putting their money. And it's kind of very interesting. So let's start with a very, very big picture. On the left-hand side, we know that when you have expanding global liquidity, that means that the Fed provides more liquidity to the markets, either via the decline in the balance sheets of central banks, either via being much looser. You always have, whenever you have an increase in the liquidity, the blue line trending higher, you have the fund flows or the risk appetite going higher and basically being invested in riskier places. And pretty much you can see that the correlation is very much alive. What is interesting to see as of late is that liquidity is still contracting. But at the beginning of this year, you saw this red line turning higher, which are the flows to emerging markets that are starting to explode. And this was much more based, I believe, on hopes of a quick turnaround and a Fed pivot than on the reality. As you have seen, the reality on the ground is not that good. Now, what also that meant is look at the in US dollar billions, the fund flows, financial flows to emerging market in 22 versus 2021. So 2021 on the right-hand side, the light blue line, and 2022 darker blue. Look at the basically gaps. You saw a sharp drop in flows in 2022. Why? Because investors, as you basically said it in the beginning, were reluctant to take emerging market risk whenever you saw a sharp rise in interest rates, meaning that the risk return profile of certain assets in developed markets were equally or more appealing than some assets in emerging markets. So also considering that emerging markets' fiscal situations and debt situations deteriorated significantly in 2021 and in 2022, partly because of COVID, that meant that you have a risk aversion to emerging markets. And this explains why did you have that drop in flows. It's something that you also see in Kenya because the markets are closed for basically Kenya. And why are they closed? Because the spreads are very high. So in here, I just wanted to give you an idea of basically the spreads. So focus on the red line, which are the sovereigns in emerging markets, X basically the problem children. So the Argentina, Ukraine, Turkey, Tunisia, Ethiopia, Ghana, Pakistan, Russia, Belarus, and Sri Lanka. These are still trading at 800 basis points, right, on average. And this is extremely, extremely high in terms of spreads, and is prohibitively expensive to roll over debt. And I believe that this is a problem that is going to stay with us for the few years to come, because a lot of emerging market sovereign have large redemptions and rollovers over the next 2 years. In particular, 2020, the end of 2023, 2024 is going to be heavy for African sovereigns. The other thing that I would like to point out is for the problem, basically, countries, look at the levels of spreads that you're having. They are extremely elevated. So that means that also those countries are finding it very difficult to refinance themselves via capital markets, and they have to rely on official institutions to bridge the gap before the reform process makes them appealable again by capital markets. In terms of flows, what have flows been doing? So if you look at the chart on the left-hand side, look at the red bars. The red bars is emerging market fixed income. So since pretty much June 2021 to almost as of December 2022, you had significant outflows of emerging market fixed income, particularly local fixed income. And this is understandable because not only did you have inflationary pressures that made domestic yields rise, but you also had some fiscal issues, some debt issues, and some risk aversion that push also their currencies weaker. So it was easier for investors to curtail their investments into fixed income. What is interesting is the blue lines, and the blue lines is equity. And equity performed extremely well, but most of the equity, most of the large, basically, chunks of equity, if you can see by the table here, is pretty much in Asia, the Pacific, right? And in Asia, the Pacific, it's pretty much India and China that are attracting the very, very large numbers. And this is something that also a lot of people are not really aware, because they see that emerging markets are receiving a lot of equity. But if you look at the amounts of equity, either they are exits or very, very small, basically, pluses. The big entrants in terms of equity are in Asia, particularly China and India. I would like also to leave you with some of the concerns to close this capital markets section that we have, and these are as to the vulnerability of certain sovereigns and the possibility that more sovereigns are going to find themselves into trouble should the higher for longer mantra stay with the Fed. So on the right-hand side, we have seen a tremendous increase in basically spreads at the sovereign level across pretty much all regions. And we also see that as a percent of reserves, the external financing requirements for last year were extremely, extremely high and way in excess for some countries of the reserves that they had on hand. And it's no coincidence that a lot of these countries you see as the countries where investors are most adverse. So again, we're very cautious going into this year, because we believe that some sovereigns are also going to continue to be affected by this environment. So now, the future. One, we said to people that global trade was going to slow down, not only because during COVID, people anticipated and brought forward future consumption in terms of goods that is now tapering off on behalf of basically services, but also the liquidity environment was going to be much less favorable to expanding trade. And essentially, this is what we saw. So the red line is basically the liquidity environment. So this is the US M2 monetary aggregates. You can basically put whatever monetary aggregate that you want. You can put Europe, you can put global, it's exactly the same shape. The blue line is export volumes. So the change year over year of export volumes. You see that export volumes are basically now, the latest figure is a negative. So we still believe that with liquidity contracting, you're going to have a global trade volumes going down. The second consideration is also geopolitical risk. And with increased basically tension between the US, China, Russia, you're probably going to have global trade that is going to, again, take a back seat within the medium term as geopolitical considerations basically expand. One of the things that we have been also seeing is that the bottlenecks are easing in terms of trades. So you cannot blame it on bottlenecks because trade is basically slumping, because bottlenecks are quickly being removed. And one of the best indicators is the Baltic Dry Index, which are the average shipping rates that cargo companies charge their customers around the globe. They have declined by 60% from the peak. So one cannot say that the bottlenecks are there and they're constraining trade. In fact, the bottlenecks are being removed. So it is really that the global economy is contracting. Then the China deceleration story. And in here, I'm probably going to go very quickly, but give you some of the hints. First, exports and imports in China are not doing well. So the imports basically is the blue line. The blue line is contracting. Contracting imports for an economy like China means that the domestic economy is not doing very well. Contracting exports, the red line in China, it means that the global economy is not doing as well as people were thinking. So this is really a double hit for China. It is an evidence that the domestic economy is still not firing in all cylinders, and that the global economy is also hurting. And this is verified by the fact that if we look at export volumes out of China, they're basically declining very, very fast. In terms of China manufacturing, you have the new orders that basically are slightly positive, but export orders are still moribund. So again, we get confirmation from the story. Also domestically, why are we a little bit more skeptical about this opening in China that is going to bring again a growth to close to the same levels that it were before, is because the real estate market in China that accounted for over 30% of basically GDP is moribund, and the government is not letting the market find basically its clearing level. And this is because they do not want to let property prices go as low as to clear the market. And this translates into an aversion by people to invest into more real estate. Evidenced by real estate construction that is declining at double-digit levels, and also land acquisitions by local governments is way down, and the housing starts is basically double the level of contraction that we see in the US, where interest rates have been allowed to find their natural basically state. So you have a market that will continue to hamper basically growth in China, because you're not letting it really clear. The other one that a lot of people were thinking about is basically the COVID. At the end of 2022, you saw a massive COVID spike, and that now has come basically to nil. A lot of people are telling you, well, maybe this number is a little bit over optimistic, but what we can see is that, yes, you have cases in China, but they are not going basically out of control. And this is at the same time that the government is unleashing some liquidity into the system. So as opposed to what is going on in the West, that you have an inflationary bout, you have a deflationary bout in China, which allows the government to increase the liquidity pumped into the system. But even that is not basically helpful. So in terms of China, we believe that there's going to be a rebound. The rebound is mostly going to be led by services, not so much manufacturing, because manufacturing did relatively well during the COVID episode. And thus, we are going to have a rebound, but the rebound is not going to last long and is probably going to be a little bit weaker than people were anticipating. So now, the last section, what do we expect going forward? A lot of people this year, so far this year, were like this little man, right? Good news, the bear is behind us, isn't behind us anymore. And a lot of people are now finding out, unfortunately, that he's not behind, but he's really in front of them again. And this is why the markets are getting spooked. And the bear is basically sticky inflation that is not basically going away, and also some increased geopolitical tensions. Now, the deceleration is here, no matter what you're hearing basically on CNBC. If you look at the numbers, you see a vast amount of companies that are laying off very considerable number of workers. And then this I basically compiled until, I would say, the end of January. I have to update this list, but it's pretty much the same thing. Now you have industrial companies that are laying off in very, very large numbers. One of the canaries on the coal mine is Wall Street basically firms. Wall Street firms have been basically doing some of the deepest job cuts since the financial crisis. And given that they are not too bad at forecasting that there's probably going to be a slump, it is interesting to see that they're firing so many people at this time, when the FT at the beginning of the year was extremely positive. If you can read what they say, things are looking up for the global economy, with basically all of what I've shared with you. But if you look at the latest employment data, you have had massive layoffs in some of the secondary indices that follow employment in the States. So again, follow what is really going on by looking at what companies are doing, not really what CNBC is telling you. We believe that more pain is yet to come, and this is because the lags in impacts to the economy. And in here, we concentrate in the States, but you could say pretty much the same thing in Europe and in other parts. But just to give you an idea of how we're thinking going forward with the lags. So I will give you 4 examples. The affordability for new buyers in terms of home in the States, it needs to fall another 20% from where we are in order to, again, become more or less affordable. So what that means is that real estate prices are going to have to fall even more than they are today. And we are already basically down 16% from the highs. Now, this housing fall has also a multiplier effect across the economy, because not only deflating asset values basically reduce the balance sheet of the households, but they also have a negative wealth effect, constraining consumption. If you push basically the thinking further, it will also compound the problems that banks have on their balance sheets. And one example that I'm going to give you is banks are tightening credit standards very, very sharply in the US. Why? Because they see this wave basically of impairments coming to them. And the last thing is this delayed effect of all of the rate increases that you saw. You have $10 trillion of private sector debt that needs to be refinanced this year at interest rates that are 400 to 500 basis points above their basically original spread level. So all of this is going to have lags on the economy, but is going to take disposable income both from basically companies and households, which is going to slow down economic growth going forward. Now, for us, the recession is already here. In Q4, you have three indicators that we look a lot. We look at retail sales, industrial production, and housing starts. It has about 94% of the time that whenever you have serious drops in these three indicators, you have a recession that follows, right? That's 94% of the time. In the latest set of FOMC minutes, the beige book that I would highly recommend you just reading the snippets and some of the CEO comments in terms of earnings calls, the main common points is that the consumer is being much more careful at where are they spending their money. They're trading down. They are opting for cheaper basically levels, flocking basically to Walmart, and the household are resistant to further price increases. Why is that important? Because over the past year, companies have made record profits because they were able to increase prices and the consumers were able to pay for those increased prices. I think that we have come to the limit of where consumers are willing to pay for prices. So in the current environment, what does that mean? It means decreased profit for companies because companies are going to face, if inflation is still sticky, higher rising costs that they're not going to be able to pass to consumers. Therefore, their earnings are going to go down and their valuations are also going to go down. The second thing is bank prepare for pain and wage growth is flat. One of the things that I read a couple of weeks ago was the earnings call from Discovery Financials. And what amazed me is that the credit card charge-offs are basically more than double this year, the projections, than last year. And this is a company that is extremely well run. So I wanted to give you an idea and just focus on the top left-hand chart and just focus on the red line. Banks tightening credit in consumer and industrial loans. So look at what is basically the very, very rapid tightening of credit. This, again, is a credit crunch in the making and is going to slow down economic activity in the States. So the question for us is the Fed going to pivot soon? No. And the Fed is only going to pivot if it sees on the left-hand side that the US inflation is probably reaching between 2 to 4%, and that you have, in terms of unemployment on the right-hand side, unemployment reaching close to 5%. If we do not see this, that means that we are still going to have a very challenging global environment ahead of us. So the global economy was doing better than expected last year, but this year is again slowing down. Emerging markets are most at risk, again, with basically authorities facing very difficult choices between financial stability and supporting growth. And again, you have disconnecting vasos in terms of a stronger dollar, lower growth, elevated debt, and higher interest rates that, as you know, are basically causing a lot of trouble, not only for governments, but also for corporates. So with all of this environment, it's not surprisingly that half of emerging markets are going to have lower growth in 2023 than they had in 2022. So for us, the risks for the outlooks are tilted to the downside, but are a little bit less pronounced than a few years ago, than last year. I'm just going to leave you this for you to read. Just pointing out on the last slide, William, turn around quickly. The answer is probably no, because we believe that there's going to be the lags of tighter monetary policy and sticky inflation to again play havoc with not only the fiscal position, but with the refinancing of emerging markets around the globe, particularly the markets that have large imbalances in terms of fiscal and debt loads. China's economy will continue to, even though it's going to grow faster than last year, will continue to be sluggish for the reasons that I told you. And we believe that the geopolitical forces around the world are probably going to intensify, which is going to mean continued deglobalization and continued inflationary pressures as supply chains are basically broken up around the world. I leave you with the list of basically which are the industries that we believe that still have a lot of attractiveness, even though even in these uncertain times. And I open up for basically any questions that you may have. And I hope that I haven't depressed you too much. Ngatia told me that I needed to be very honest with you. So I have been extremely honest with you, and please, if you have questions, I am here to take compliments or complaints. I will take both. Over to you, Ngatia.
Thank you very much, Jean-Pierre. A couple of things have stood out in the presentation. First, more pain to come, and that the recession is here. Very, very worrying to hear that. We were all hoping that we would be coming out rather than going in or further into a tough economic and investment environment. Next, we talk about the expectations of further tightening from the Fed, as well as in other DMs in developed markets like in Europe, and that EM flows, although EM flows have picked up as a percentage, and they are doing that ahead of the rest of the regions, or ahead of the rest of the pack, the fundamentals are telling us that there are challenges ahead for the emerging markets, including Kenya. Now, if we talk specifically about our not directly about Kenya, but let's talk about Africa or EMs in general, there was an interesting slide you had there about the refinancing needs of these countries versus their reserves. And that's extremely topical in Kenya right now. It sounded like you were talking about our current situation, where we have a couple of big Eurobond repayments coming up in the next, I'd say, 24 months or under that. And our reserve, I believe, stand to be corrected, would also be under pressure. So when you talk about the market being closed ahead of these, the need to refinance our external debt, is it really a question of the market is completely closed, or is it a pricing question? Essentially, is it just the price is what it is, and if we want to refinance, we have to make peace with the fact that we'll be doing it at those spreads of 800 plus? Or are you saying that if we went to the market today as a country and decided we want to refinance $2 billion to $5 billion worth of external debt, we would find no bids, no takers for that? So let me start off with that question as I ask the rest of the audience to please put their questions into the chat box. where we can then now read them out to Jean-Pierre, and he can answer. So Jean-Pierre, over to you while we wait for everyone else to write in. Thank you.
I think it's a very good question. First, let me basically say that during my trip to Kenya, it was obvious that on a relative basis compared to other sovereigns in Africa, Kenya is doing better because you have large economies that have political issues, that have serious macroeconomic issues, that have markets on the exchange that are controlled to a point of having multiple exchange rates and are not working very well. Most of you know which country I'm talking to. So on a relative basis, they are not doing bad if you look at it from an investor. Now, on a standalone basis, what is worrisome in Kenya is basically the dual deficits. You have a current account deficit and you have a fiscal deficit. So yes, that you could refinance, but you're going to have to pay much higher spread levels, which are going to, again, hinder even more your fiscal challenges. So I think that a lot of governments in Africa and in emerging markets are using basically accumulated reserves or their access to concessional financing in the hopes that the global economy is going to stabilize and they're going to be able to access public markets in the near future. With the picture that I showed you, public markets are still going to be expensive for longer. And that is basically a fact. What is a silver lining for Kenya is that Kenya is viewed as a country that to a certain extent is, on a political point of view, is mature with successful elections, with a peaceful, basically, elections, with people pretty much backing most of the government's initiatives, with a government that wants to be orthodox in its plans, and a country that is productive, that is innovative, that is probably the engine of East Africa in terms of regulatory policy initiatives, in terms of financial hubs, in terms of fintechs and so forth. With that comes also the official help. So the bank is as you know, has already basically signed a very large DPL with Kenya. The IMF is ready to support Kenya. So I think the official community is probably going to be very supportive of Kenya. Of course, that means that the government is also going to have to do its part, which is trying to do by basically cutting expenses. So, and that is also compounded by a shortage of foreign exchange that was first basically introduced to Kenya with the commodity shock, where a lot of people have to scramble much more basically dollars to pay for much higher commodities. But now it has moved to people anticipating a potential lack of basically supply of dollars and purchasing dollars today, which again aggravates the dollar shortage. So all to say that, yes, that Kenya can refinance itself, but it's going to be extremely expensive to refinance itself. So it's preferable, if you have official assistance, to do it via official assistance, particularly if you do not want to put any more pressures on your fiscal accounts. From a comparative basis, if investors look at it, is one of the countries that is probably doing the best in Africa. So that is also what a lot of people are doing. Let me see. I'm going down through the list of questions. Ngatia, if you allow me. Vivek,
yes, please go ahead.
Where did you get your cartoons? Let me start with that one. Hedgeye.com. and hedgeye.com, I've known them for quite some time. They're an independent research, basically, engine geared towards the US market. And they have some by far the best cartoons that I've seen. So I am a subscriber and I use them in my presentations. So if you want to, please access them. They are extremely funny and pertinent. Where is the silver lining for African countries? Also for Vivek. I think the silver lining is going to be one, how does Africa position itself with this increased geopolitical competition? And let me be extremely honest, I think that Africa is going to be pulled between the US and between China, Russia in the other side. I think that Africa has matured to the point that they're not going to choose one side, but they are going to try to get the best deal possible by looking for their interests. So that means that there's huge potential in terms of critical minerals. As you know, if geopolitical rivalry continues to increase, the world's foremost producer of critical minerals, China, may be less willing to provide critical minerals to the rest of the world, particularly the West and the US. So that means that both Europe and the US are going to have to find alternative sources of critical minerals, particularly if they want to do the energy transition, the green transition, at the speed that they want to do it. That means that you have a lot of places in Africa that could provide, for example, lithium, that could provide other critical minerals that are going to be extremely critical to this green transition. The second one is the imperative of the Europeans to win off the Russian, basically, energy, and they're going to look for other sources of gas that are closer to home. That again opens opportunities for some African nations. The third is on the agri-business side. With basically climatic changes all over the place, some countries getting drier, others getting wetter, you have in the southern and middle belt of Africa, you have some of the most fertile lands in the world. And I think that's a big opportunity for you to exploit. The fourth one leads to basically technological improvements and the inclusion in terms of the African basically trade union that is going to create really regional markets for African goods. Still, most of Africa imports a lot of their consumer and manufactured goods, and you could have some silver lining in terms of facilitating the production of certain goods for regional distribution. So probably let me stop at there, Vivek, because I want to also let me see. I want to address others. Swake, I think you have half a message, because I only can read this. Hello, Russia issued a statement saying, and there's nothing else. So
the question is downstairs below that.
Yes. How do you think Russia's plan to cut fuel production will affect global prices? We expect a continued decline in global food prices going forward. Yes, with Russia, you have basically the mix of China into the mix, because Russia is not only in isolation, but is mixed with China. Why? And of course, Chatham House rules. This is my personal impression, is not the impression of the World Bank or IFC. So please do not quote me on that. If you see, there's a marriage of convenience between China and Russia. China would like basically some military technology from Russia, also some cheap commodities, and Russia gets basically a customer that can take large amounts of its commodities right at its doorstep. So it can be a little bit more aggressive, I think, with the West if it has the understanding with Russia that Russia is going to be a takeout. It is something else if Russia was alone and that China was bending with the West in terms of imposing sanctions, but that is not the case. So what happens if they basically plan to cut fuel production? One is that it's not that they plan to cut fuel production, it's that they have no other ways but to cut fuel production. With all of the embargoes, you do not have the ability of offshore services of oil fields to come anymore. You have some of the friendlier nations to China that can provide assistance, but it's not to the same level. That means that no matter what you do, if the current sanctions stay in place, oil production in Russia is going to decline potentially this year by a million barrels or plus this year. So I think it's funny that the Russians basically threaten to cut oil production when in reality is that they cannot maintain oil production to the level that they have. So you have some sort of a marketing good marketing here. The impact, if they decide to definitely cut off a production on the West, is that you're going to have another inflationary bout. And with another inflationary bout, that means that central banks are going to have to continue raising rates with obvious consequences for basically not only inflation, but also risk aversion for riskier asset prices around the world. So it's something that I would be very worried. Samir, why are most African countries facing a US dollar sourcing crisis? What, in your opinion, is the single largest factor contributing to the situation? And what is the possible solution way forward for African countries to work around this situation? I think it's not only African countries that are being affected by this. I think it's emerging market countries. If you have a strengthening US dollars, that means that imported goods at the domestic level are more expensive. These more expensive imported goods fuel domestic inflation. With fueling domestic inflation, that if you are a more or less open economy with some capital markets activities, it basically turns off the risk appetite of foreign investors as they see inflation going higher and rates going also higher. They buy hard currencies, so they get out of the domestic market. The getting out of the domestic market also puts some uncertainty into the minds of locals who also basically reach to buy hard currencies, and then you have a devaluation. The central bank, in turn, increases interest rates in order to fight inflation, but it also controls the pace of local currency weakness versus the hard currencies. And that's basically the conundrum that most emerging markets have been facing so far. Now, what can be done in order to counteract? One is to, it's very easy said, but rather than done, but the countries that have been adopting credible orthodox macro policies are giving the benefit of the doubt from capital markets via a little bit more access and a little bit less spread premium. The second one is also the attentiveness of the international financial institutions to the very challenging situations at the domestic level. That means you have seen, particularly in Africa, that the fund is very active in creating new vehicles in terms of their food program, in terms of their rapid facilities, in order to provide assistance and liquidity that is not tied to a formal IMF program that is going to be much harder, at least in the short terms, in terms of economic activity. You also have the World Bank and other IFIs that are also increasing their concessional lending into emerging markets. So I would say that's those are some of the ideas to basically work around. Eric, Kenya is making ambitious efforts to try to attract investment into special economic zones more than it has done so far in the past. Do you think the changing supply chains globally would attract additional investments in the country? Yes, particularly that you have several things that are going on at the same time. You have global supply chains that are leaving China. Over the past 3 to 4 years, over the past 5 years, they went at the periphery in Asia. But now people are also saying, well, if these geopolitical forces are increasing, maybe I should locate my value chains closer to my consumption centers. So that means for the US, you had a lot of activities that were onshored, particularly the ones that can be automated, or nearshored to Mexico, to other parts of the Caribbean, República Dominicana, Dominican Republic, and so forth, for other activities. Now, in the case of Africa, you have the possibilities to vertically integrate some chains. Not a long time ago, we're looking at Ethiopia as the possibility of vertical integration for manufacturing of textiles, because of their ability to basically produce some of the cotton and their proximity to European markets and the willingness of European investment to come and really vertically integrate. So you always have that moving to the west of value chains that is going to benefit Africa. The second one is the value chains not for export outside Africa, but for export within Africa. The regional basically markets are extremely important for Africa. And I believe that they're going to become more and more important for Africa as we continue into this very difficult period. Some of the rates of growth in Africa for African countries are much higher than you're going to find elsewhere in the world. And the benefits sometimes that you could get from export substitution, and particularly not only at the country level, but at the regional level, are going to free up also some much valued hard currency resources for the countries. So for me, I do believe that the special economic zones are probably going to be a good idea if targeted to markets that are not only external, and with external, you basically could have some other variables propping in as to protectionism and so forth, but much more for intra-African trade. And the last one, I think, is an anonymous attendee. Any risk that Kenya is likely to default in meeting her domestic debts? This is a very interesting question. I think that we are far away from a default in terms of the domestic debts, particularly with the help that you could get from IFIs. Let me put it bluntly. I do not believe that Kenya is a Ghana. So no, I do not believe that we're likely to default in the foreseeable future in Kenya. So Ngatia, over to you. I think I exhausted the questions.
Yes, you did, and thank you so much, Jean-Pierre, for your frankness. Maybe in closing, I'll just ask the question that I know is on a lot of our audience minds, which is, how should we play the current, or at least thinking about the next 6 months into 12 months, the market? So we can have maybe a quick fire round here. If I think about the developed and emerging market equities and fixed income, positive, negative in your view, the next 6 to 12 month horizon? And how about other asset classes such as commodities, positive or negative? And where positive, how should we be thinking of playing these opportunities?
My goodness, I should start charging you a fee, for all of this, for all of these things. No, but I gladly share my own thoughts. And again, okay, you understand why I'm saying this, but this represents only my personal views, not the views of IFC or the World Bank. In terms of asset classes, I think that the environment is going to be volatile, but some of the things that you can basically already start seeing. If you look at equities, and I'm taking the example, for example, of US equities versus US government fixed income. Dividend yields are sub 2%, and you can get almost 4% in government bonds. Usually, historically, when bonds basically got to north of 4%, you have the possibility of making decent returns, particularly if you have a recession looming on the horizon. So for me, I would take opportunities to invest in US fixed income, probably 5 years, 10 years, whenever you have bouts of excessive, basically pessimism in terms of elevated inflationary expectations as you have been having now. If we are correct, and if we basically are going to have much more of economic impact from everything that is going on in the world, in the next 12 months, you're probably going to see lower interest rates, particularly for the US. Now, one exception to that is if you have higher geopolitical events, such as basically Russia, the excellent question that was posed. Who was it? Let me go here. The excellent question that was posed by Stellar. What happens if basically Russia cuts off supplies? In that case, interest rates are going to go higher. And you're not going to be finished yet. But even if interest rates go higher, that means that the ensuing recession is going to be bigger. And it means that the return to the mean of rates are probably going to go lower. This is for the short term. For the medium term, what I see is geopolitical competition for basically resources. That means that commodity prices are likely in the medium term to stay elevated. So commodity prices are probably going to do well. Several examples. Oil is probably going to do better whenever China starts really getting out of its slump. And whenever it starts rebuilding on force is massive inventories for basically geopolitical independence. Let's put it that way. Gold, I think, would be a very good asset in terms of protection of assets, because everything that I told you about increased geopolitical confrontation means that you're still going to have basically sticky inflation going forward with the potential of crisis here and there. So gold is probably something that everybody should have in their portfolios. Equities, on the other hand, are probably not at this point my favorite asset class, because I do not believe that they're cheap enough and they do not discount the contraction in terms of earnings that we're going to see, particularly if we enter a recession. Know that always it has been the case that the sweet spot to enter equities is not ahead of everybody. You can be an oracle, but it's better to be safe rather than sound when investing in equity with the volatility that you have nowadays. It's always after the Fed stops basically, or a little bit ahead that the Fed stops easing, that the sweet spot in basically equity is, because then you basically have a secular market in equities, which we do not have in the moment. The others are some of the ideas at the sectoral that I shared with you in terms of the presentation. So you can see that on slide 53 of the presentation. And some of those, let me just share for everybody to see. some of those are pretty much very self-explanatory. Let me put it here. Hold on. Okay. Voila. So you're still going to have opportunities in pharma, particularly because the pandemics of the virus are with us for as far as the eye can see, but also because there is this necessity of countries or regional country blocks to develop their own pharma independence. What happened during COVID and the dependence that the world has, particularly in pharma components on India and on China, pretty much 80 to 90% of pharma components come from those two countries. And this is a problem if you continue to think that there's going to be continued basically geopolitical tensions that are going to reduce basically the tradability of those goods, or you still believe that there's going to be more viruses coming. The second one is basically the agribusiness, the farmland, and so forth. That is a theme that is going to continue, particularly as we face drought conditions in other parts of the world. What is also going to be linked with this moving away from the supply chains and keeping more inventory on hand means that warehousing is going to be a big theme going forward, and particularly automated warehousing in order to decrease the cost. So this is something that we're really looking at in terms of opportunities. You mentioned alternative investments. That goes without saying. Robotic technologies, again, green commodities, what I mentioned as one of the potentials for Africa, the copper, graphite, nickel, lithium, cobalt, aluminum, silver, and uranium. Those are going to be in great demand for as far as the eye can see. Carbon credits, the ability to monetize carbon credits for the private industry, particularly in Africa, is going to be a big, big theme, and is one that IFC and the World Bank is working very hard at it. Linked to your Russian comment, the Russian energy transition will continue, which means that you have, again, opportunities in hydrogen, LNG, shale oil, and uranium. And some of these are really at the heart of certain African nations. So these are probably some of the opportunities at the sector level that I would do. Again, be prepared for volatility in public markets this year because of the environment that I told you, but you still have some opportunities within that environment, right? Because you have to see what are the ranges of basically trading of certain asset classes. Are they really cheap? Are they really expensive? And you're starting to see that some asset classes are cheaper than others. So fixed income, if you look at a high-grade company in a developed markets that is providing you in excess of 200, 300, even 400 basis points north of treasury yields, I mean, where can you find that type of return with embedded risk, right? So we do not go down market, do not go second tier, third tier. I think in the current environment is very, very dangerous. But look at basically the behemoth of this world and look at opportunities to get exposure to some behemoths if basically equity prices really take a downdraft, or if you find attractive opportunities in terms of investing in the medium term, let's say 5 years in some of the corporate bonds, you're going to find some very attractive opportunities out there that are going to be able to, you're going to be able to diversify your portfolio in a risk prudent way. Let's put it that way.
Excellent, excellent, Jean-Pierre. Let me just recap that. So thank you for first putting on your switching on your crystal ball to look into the future for us, even if these are just your opinions. US Treasuries, 5 and 10 years, interesting. The risk there being geopolitics and the potential for a crisis, which would lead to higher rates. But at the same time, those higher rates will lead to a higher chance of a recession or a greater recession, which in turn would result in lower rates. So in the medium term, very interesting. That sounds a lot now. We have to think about market timing. We spoke about commodity prices potentially doing very well, or potentially doing well, considering the potential for China recovery in the terms of oil, and that gold is a good asset class considering the sticky inflation and good protection against any potential geopolitical crisis. In equities, we're not yet there, especially with the ongoing recession fears. And your advice is better safe than sorry. No need to be at the front of the pack for that, considering that the sweet spot for equity investments is when these global, the central banks, especially the Fed, stop easing. Mm-hmm. For the audience here, when I think about those recommendations, a couple of things stand out. First, in your recommendations that you put up just now, we saw a number of REITs. Yeah, so REITs in the industrial space, warehousing, as well as e-commerce. There's been a big push for greater REIT investments in Kenya, and that was very encouraging to see that it is, we are well primed to, at least in terms of access this asset class. On gold, we do have a gold ETF currently that I know has been outperforming the rest of the market. And so this is definitely something that our members should take a look at. You mentioned alternative investments due to expectations of lower returns in public markets. Like we started off, that's exactly the reason for our existence as the Kenya Pension Fund Investment Consortium, to look at these alternative investments. So, this is more reason to urge our members, to urge the pension schemes out there to look at infrastructure and other hard assets, private equity as well. And interestingly, you also mentioned ESG and carbon credits. The reason why I want to talk about that is the President of the Republic of Kenya has made it clear that he wants Kenya to be a major player in the carbon credit space. Lastly, you mentioned that there are opportunities within, let's call it tier one corporates or tier one opportunities out there, and that with that in mind, there would really not be too much benefit from a risk return perspective from going down the credit level, so tier 2 or tier 3 opportunities. Jean-Pierre, thank you so much for your time. This was really illuminating. And to the audience who have joined us today, thank you for giving us your 90 minutes. We will be sharing this presentation with you all, and feel free to reach out to ourselves, the KEPFIC Secretariat, for any further questions, which we'd be happy to answer. Jean-Pierre, once again, we thank you for making time in your busy schedule for us, and we look forward to future engagements. Thank you very much.
No, thank you very much to all of you. I feel I should send you several pills of Xanax after my presentations, but it's better, we're very honest, and I think it's a story that you're not going to hear everywhere, but we prefer to be as honest as possible based on the data and of the analysis that we do. So please feel free to reach out to us should you have any more questions. Again, it's a pleasure to share our views with you. I hope that we're going to see you soon. And please, Ngatia, do not hesitate to reach out to us if you have any questions or if you want other presentations in the future. It has been a really, really great pleasure. And I thank you for your time and the opportunity to present to you.
Thank you. As we say here, asante sana. And until we meet and speak again, God bless.
God bless. Bye-bye.